Dividend investing is one sure way to make more cash from a simple investment. However, while popular funds like SCHD and the S&P 500 may seem like the go-to options, there are some other index funds out there that can give you a magnificent boost in your income and returns. One such index fund that is often overlooked is the DGRW Index Fund. In this video, we'll analyze this fund, including its asset classes, performance history, expected return on investments, and more. Stay tuned. If you're a fan of investing, surely you've heard about the ETFs or exchange-traded funds. These are unique types of investments that give you monthly or quarterly dividends based on your invested account. However, most first-time dividend investors simply hop onto popular funds like the SCHD without doing proper research into other possible high-performing funds. This is why many have passed out on the DGRW despite its huge potential and phenomenal performance history. The DGRW, or WisdomTree U.S. Quality Dividend Growth Fund, is an ETF focused on large capital companies in the U.S. market that pay dividends. Long story short, this dividend is good for you if you're seeking to invest in large cap companies that are currently doing well and whose dividends are also growing. It's also ideal if you're a newbie seeking high dividend yields but have no specific investment strategy. According to the official DGRW website, the key takeaway is that the index fund tracks large cap dividend growing companies. That alone is enough to tell you the cash potential of this index fund. And here's another interesting thing. This fund gives you access to some of the top companies in the world. As of November 2023, the total assets of the investment fund is capped at $10.27 million. Its dividend yield is a whopping 1.88%, and its annual dividend for the year 2022 was $1.22 per share. Also, at the time of making this video, this fund was priced at $65. Now let's see a brief history chart. DGRW was a mere $25 per share when it launched. So this means that the index fund has gone up by about 164%. Now, all that you see in this chart doesn't include dividends. So imagine how lucrative it must have been for early investors who bought at its launch. By now, they'd probably have made triple or quadruple returns on investment, especially considering that this fund pays monthly dividends. Now, let's talk about DGRW's performance and how lucrative it can be if you invest today. Over the years, this dividend has seen a progressive rise. The dividend was launched on the 22nd of May, 2013, so it's been around for about 10 years now. The interesting thing is that this ETF looks promising and is most likely to continue its progressive upward trend. But then, you'd agree that an index fund is only as lucrative as the company or holdings it offers. So what exactly does this ETF offer as its investment portfolio? Well, everything. The DGRW is not only a well-diversified ETF, but also very inclusive of most lucrative types of assets. It gives you the opportunity to invest in technology, industrials, healthcare, real estate, energy, and so on. In total, there are 11 main asset classes, with technology carrying the most weight or percentage. The next big one after technology is consumer defensive at 16%, followed by industrials at 14%, healthcare at 13%, financials at 12%, consumer cyclical at 9%, and others like basic material, real estate, and energy taking the lowest percentages. Now, I know not everybody is a fan of tech investing, but you can't argue that our world today is basically run by technology. As things like AI, phones, machine learning, and quantum computing continue to evolve and influence our lives, the tech industry will only become more lucrative. The DGRW allocates about 30% of its holdings to technology. In the overall holdings, you have companies like Microsoft, Apple, and Broadcom Inc. coming in at the top three. Now, I'm sure you can see why this ETF allocated a considerable percentage of its holdings to tech. Even if you're not a tech fan, you can't deny that companies like Microsoft and Apple have been killing it for the past 10 years and are not set to go down anytime soon. For example, Microsoft is the largest investor in OpenAI, the company behind the popular ChatGPT. OpenAI is set to break records in the AI space, and Microsoft itself is pushing for new grounds in the tech industry. So you see, you can never go wrong investing in such a company. This ETF helps you do just that. And then there's Apple, the company famous for premium phones and laptops. These two are great choices even for direct investments, but I'm sure you want to play it safe. This is why ETFs like DGRW are the way to go. In the case of a temporary setback, you can rest assured that your portfolio will adjust accordingly to ensure that you never lose cash. This is because the DGRW has over 200 different holdings combined. For the sake of clarity, let's compare the DGRW to another popular index fund out there, the SCHD. While the DGRW has 297 holdings, the SCHD has a mere 104. Also, considering the top holdings as of November 2023, there are significant differences. The top 3 holdings for the SCHD are Amgen, Verizon, and Broadcom. Each of these hold a weight of 4.6, 4.4, and 4.3 respectively. Now, that's a huge letdown compared to what we see in DGRW, where Microsoft, Apple, and Broadcom carry weights of 9.6, 6.0, and 3.7 respectively. This means that with SCHD, the index fund shares the overall investments almost evenly across all holdings. This may seem safe, but then again, it doesn't take advantage of top-performing stocks. Meanwhile, with the DGRW, top performers like Microsoft are given more weight so you can make the most cash out of them. Personally, I prefer the DGRW setup, as it's more rewarding for investors and offers more holdings. Now, let's consider a typical scenario of how things would have turned out with an investment of $10,000. Going by the current yield rate of this ETF, a $10,000 investment would amount to $17,098 in 5 years' time. However, over the course of 10 years, it would sum to $30,245. Now, that's quite impressive, even compared to other popular ETFs like the SCHD. Next, let's see the dividend growth rate of this ETF. The 3-year dividend growth rate is 6.04%, while the 5-year and 10-year growth rates are 7.84 and 20.39% respectively. These numbers are impressive, considering the fact that popular ETFs like the S&P 500 have only managed to attain a 10-year growth rate of 12%. Now you know all about the DGRW. You're probably wondering if there's any letdown or downsides to this ETF. Well, there is one: the expense ratio. The expense ratio tells how much a fund's assets are utilized for expenses. It typically tells how much you pay over the course of 1 year to own an index fund. The DGRW has an expense ratio of 0.28%. For an index fund, this ratio is quite high. Some funds offer ratios less than 0.2%, with a few notable ones like the SCHD and the Navi Nifty 50 Index Fund, going as low as 0.06%. To put it into perspective, for every $10,000 you invest, the 0.28% ratio will mean a deduction of $2,800 yearly. Now, you'd agree that this is quite high, but honestly, when you consider the huge profit potential, you'd see that this loss will balance itself out in the long run. Another thing that may make this dividend ETF seem a bit controversial is its changing dividend payouts. The monthly dividend payouts aren't consistent, and some months can be as low as 7 cents per share, while others can be as high as 20 cents per share. This rules out the possibility of predicting your monthly dividend returns. But at least you're sure of getting some cash monthly, which can be quite beneficial if you're planning to live off dividends or maybe just some cash in your pocket. The truth about investing in ETFs like DGRW is that you can either withdraw and consume your dividends or reinvest them to get an even higher reward at the end of the investment term. The choice is up to you. In any case, with a $50,000 investment in this ETF, you're probably set for life. At the end of the day, DGRW is an ideal option for anyone who is seeking a good, high dividend growth ETF that features top performing companies and pays monthly dividends. The history of DGRW is quite impressive, and given the past trend and the current holdings, the future looks promising too. This ETF ticks all the right boxes except the expense ratio. But then again, you can't have it all in one ETF. You just have to pick based on your priorities and preferences. Remember to subscribe to our channel if you found this content valuable, and I'll see you in the next one.